Okay, so nice to be here, and so nice to see all of you here as well. I have a presentation that I hope you will find interesting on the global economy. You can see that the title is a lot of focus on politics these days, and I'll touch upon that, of course, but also on some other topics which I think that you might find interesting. So let's kick off. Okay, this is a chart that on first glance may seem a little bit messy. It has to do with the US. Do you know why economists are so preoccupied with the US? Well, first of all, it's the biggest economy in the world, but that's only part of the reason why economists are so focused on what's happening in the US. The other reason is that the US economy has leading properties, i.e. what happens in the US tends to happen in Europe and elsewhere in the world with some delay. So this is a snapshot of how the US economy is doing right now. And the way you should read this chart is that on all these different indicators that each sort of signal something about the state of the US economy, you should read the diagram as from the center out to the rim. You have 10 years worth of data for each indicator. And if you are the orange line on the rim, that means that that indicator is now signaling the strongest positive momentum it has done in 10 years. So obviously you can see that there is a lot of strength in the US economy as of today. The weakness is, well, the budget is weak and also wages are not increasing as fast as you might expect given how tight the labor market is. But overall, the US economy is doing very, very good at the moment. So, the fact that things seems to go so well and have been going so well for such a long time is something that it's starting to make people concerned. This chart shows you each of these dots represents a period when you had economic expansion in the US, i.e. positive growth. And it goes back all the way to 1949, and on this vertical axis you see the average growth rate that the economy had during each expansion period. And on the horizontal axis you see the length of each of these periods. So, is there a pattern here? Well, not an obvious pattern, right? But if you look at where we are right now, we're actually here. The current period of expansion started already after the financial crisis in 2009, and it's currently the second longest of all of these periods. But you can see it's also the weakest. And the question now is, are we going to break the record? Which we will do next year if the expansion continues. And we think we will. And the reason is partly that growth has been so weak. It's been going on for a long time, but it's been weak. So that means that it also has the potential, as we see it, to go on for a bit longer. But today, there is a lot of concern that we are in a late stage in the business cycle, and that the downturn is almost inevitable to come at some point. If you want to follow how an economy is doing, there is no better indicator than to look at surveys like the ISM index. Basically, where you go out and ask companies like yourselves in the US about what they think about the business cycle. And you can see it's been a volatile ride over the last three decades. Right now we're here at a very high level. Optimism in the US is strong. But you can see that it's very uncommon that we stay at these elevated levels for such a long time as we have so far. Okay, let's say that this reading was the peak and we've now started the decline. Should we expect a gradual decline? What do you think? What does history tell us? Not really, right? Usually declines are quite steep. Another question is, of course, what happens in markets? Let's say that we are now heading for a decline. What will happen in markets during such a period when the ISM, the corporate index in the US, is falling rapidly? Well, I've looked at that, and the results will be shown in this table. If we start by interest rates, what do you think will happen with interest rates when the economy is going down? Higher or lower? Lower, correct. If you look at how the US 2-year and especially 10-year interest rates have performed during a period of declining ISM, you can see that they almost always fall quite rapidly. Okay, currencies. What do you think about currencies? What do you think will happen to the dollar when the US economy is going down the drains? Stronger or weaker? Weaker? Stronger? Well, usually it actually becomes stronger. If you see euro dollar here, usually goes down when we have a period of weaker US growth. Okay, the oil price. Everybody's focusing on the oil price these days. What do you think will happen with the oil price? Higher or lower? Lower. Well, it's half right. Actually, there is no consistent pattern when it comes to the oil price and weaker economic growth in the US. Okay, the last one, which I think that you are most interested in, what will happen to the stock market in that kind of an environment? Will stocks do fine or bad? Higher or lower stock prices? Lower? Okay. Well, usually stocks do quite fine. In fact, stocks really only do really bad when you have a recession, a period of negative growth. If you just see a sort of slowdown in the business cycle, stocks usually do fine. But today, there are all these concerns that we are at the very end of the business cycle upturn and that we are heading for worse times. And I mentioned the oil price. Obviously, that is a factor. This is the oil price development that we've seen over the past year and a half when oil prices have actually gone up quite a lot and are now trading around $85. Quite high, and people are expecting it to go to 100. And this is a problem, or a potential problem for the world, because if you see all the countries here that are green, those are countries that benefit from oil prices going lower, but of course also are hurt when oil prices are increasing. And that's basically most of the world. Our forecast at SEB is that oil prices will remain around these levels for the next 2 years. Short term, perhaps a risk on the upside. But I tend to focus a lot on the long term. And when it comes to the long term with oil prices, I mean, today we have this market imbalance. Basically, that supply is being disrupted now with sanctions against Iran and such things. And we have strong growth. So that's the short term. But if you look at the long term, you need to focus on what is the future demand for oil. And we all know about this powerful trend that is now sweeping across the world that involves automotives, switching to electrics. And if I was an oil producer, a sheikh in Saudi Arabia or somewhere else, I would think like this. Most of my wealth is beneath the desert sand in form of oil reserves, and there is a limited period when I can actually benefit from this. And I better pump as much of it out of the ground as possible in order to be able to sell it while there is still a decent market for it, right? So I think that in the long term, we will still have a sort of structural supply or oversupply of oil because of this very powerful trend. Okay, let's go back to the recession. Are there any reliable recession indicators? Well, there are, actually. One of them has to do with the fixed income market. And this is US 2-year interest rates and 10-year interest rates. And the normal pattern is that 10-year interest rates are always higher than 2-year interest rates, just as your mortgage, right? But at certain intervals, this actually switches. So 2-year interest rates rises above 10-year interest rates. And if you look at that difference, you can see that in this chart. And that has proven to be, historically, a very reliable recession indicator. You can see here that when this spread turns negative, we have a recession about 1.5 years into the future. It's worked all these times. Right now we're here. So it's not really sort of signaling that you need to switch all the alarm bells for a recession on right now. But this is something that I focus a lot on. Okay, let's briefly leave the US and look at what is happening in the rest of the world. This is basically the PMI indices, corporate surveys for a lot of different countries, and it's a lot of green these days. You can see that most of the European countries, of course the US, are all in this upper panel. Growth is strong. The greener, the stronger the growth momentum. And in this lower chart, you can see that you have a lot of the emerging market economies. But things are not really bad in those countries where growth momentum is slightly weaker. For example, China has been very stable for a long time. Growth is softening a bit in China, but not to the extent that is making people worried. So, overall, it looks to be quite a good couple of years ahead. This is SEB's forecasts about what's going to happen to global growth over the coming years. And as you can see, we see a slight decline here, but it's on the margin. I should be honest with you, making forecasts for global growth 2 years ahead, that's sort of borderline to fortune telling. We don't really know what will happen 2 years ahead. So economists tend to say, okay, let's put it around where it usually is. So take this with a grain of salt. Okay, you can't talk about the global economy or the US without talking about Donald Trump, right? Do you like Donald Trump? Okay. Trumponomics. Well, I usually summarize this as it's a mix of joy, hopes, and fear. And the joy part, we got already earlier this year when they released this tax reform that lowered taxes for both corporates and private individuals. And the only problem with this tax, or there are two problems with tax reform. One problem is that it's extremely ill-timed. Because normally you want to add stimulus to the economy by lowering taxes at a time when the economy is not doing so good. Now they're doing it when the economy is booming. And that is adding extra stimulus to an economy that is already borderline to overheating. The other problem with the tax reform is that it's not funded. It's underfunded, so it continues to increase the US deficit. And this is a forecast by the IMF made a few quarters ago. And all these countries, it's probably difficult to see the names here, but all these countries, basically the whole world, is expected to pay down its national debt over the coming 5 years, except this red one, which is the US. The second pillar of Trumponomics is in infrastructure investments, and Donald Trump likes to build things, and so far this has not delivered a lot. Actually, it's delivered very little. And the problem here is structural, because investment decision in infrastructure is not taken at the federal level. It's taken at the very lowest local level in the US. So the federal government has very limited power over that part of the economy. Both these measures are good in terms of that it generates growth, not just in the US, but also elsewhere. But what is the third pillar of Trumponomics? The fear factor. I'm sure you know it. America first, protectionism, all that kind of problems. It all emanates from this. This is the US trade deficit, and we're not talking about overall trade, we're talking about trade in goods, things you can touch. It's more than $800 billion on an annual basis now, and Donald Trump has made it his promise to the voters that he will actually turn this around. So, do you think he's going to be successful? Well, first problem is that the tax reform has some side effects. If you cut taxes for people, well, then they tend to get more money left, which they can spend. And what do they spend those tax returns on? Imports, exactly. And more imports means that the deficit will rise as a result of this tax cut reform. Are there any other ways that you can fix a trade deficit? Well, one way, of course, is to start meddling with the currency. If you weaken your currency, of course, that is going to make imports more expensive and exports cheaper to foreigners, and that is going to sort of help closing the trade deficit. So, what about the dollar? Well, this is the dollar development since spring of 2017, and it's very difficult to find any decent forecasting methods that work for the dollar. Usually the central bank interest rate is a good predictor. Nothing has really worked. So I turned to politics. What happened here in April when the dollar was trading 106 against the euro? Well, Donald Trump happened. He came out and he said this: I think our dollar is getting too strong, and partially that's my fault because people have confidence in me. Okay. It's a modest man, humble remark. Nevertheless, that actually proved to be the turning point, and the dollar started to weaken until this point. Again, Donald Trump out saying, the dollar is going to get stronger and stronger, and I ultimately want to see a stronger dollar. Dollar stopped weakening, and it's now sort of, well, it's right where the president wants it, right? Between 106 and 125. So, I don't think that we should look to the dollar to do the trick in terms of fixing the trade deficit. It's going to take much more in terms of dollar weakening to even make a small dent into the trade deficit. We actually think that the dollar against the euro will remain around these levels for the next year. So, then you have this. This is a very brutal way of trying to fix your trade deficit. And the problem is that it also hurts the US. So what are the negative effects we could expect on global growth, on US growth from the trade war that has now been going on for some months? Well, the IMF has made some calculations, and given all that has sort of been presented so far, their worst case scenario, basically, they expect that the world over a 3-year period probably will have 1.3% less growth than otherwise. So a few tenths of a percentage points each year in lower growth because of the trade tariffs and so on that we've seen so far. The US will be slightly more affected. But it's interesting, this with trade, right? Because if I ask you, I mean, globalization, is that dead? This is, I think, an interesting chart. It's difficult to measure globalization. But this is done by the Swiss Economic Cough Institute, and they've tried to measure globalizations over the last 50 years. And the interesting thing here is that you can't find any period where globalization seems to go in reverse. It's always increasing at different paces at different times, but it's increasing nevertheless. And have you thought about what are the drivers of globalization? Have you thought about that? What is the prime driver of globalization? Technology. It's a gold star for whoever said that. 1800s, that was a century where we had a lot of globalization, and that coincided with a lot of new inventions. Especially we had the steam engine that made transport both over land and sea possible over much greater distances at much shorter times than before. Together with communication, that sort of fueled globalization. In the 1900s, we had massive development of communication and also logistics that drove globalization in that century. And what has happened in the current century, the 2000s? Have we had any good inventions that promotes globalization? Exactly. Internet, right? Suddenly globalization is not something that is restricted to just big companies. Everyone is part of this now. Usually you also need a sponsor, or that has been the tradition. What was the country, the influential country that sponsored globalization in the 1800s? Great Britain, exactly. And in the 1900s? The US, correct. And which is the power that today sponsors globalization? China, exactly. And this also marks the switch of influential, right? The UK was the most influential economic power in the 1800s. That switched to the US, and it's now about to switch to China. Have anyone seen this symbol before? Have you heard about the Belt Road Forum? The Belt Road Initiative. It's basically a huge infrastructure project that is driven by China with the aim of connecting Asia with Europe, trade-wise, both by sea and land. 70 countries are involved somehow. There's been a lot of criticism against this project because it's influential, or China becomes more and more influential. But China is about to spend about $900 billion in infrastructure investments in this project over the next 10 years. So this is globalization in action, happening here and now. So my bet is that globalization, no matter what will happen with trade, the trade war, will continue to increase over the next 5 years. Okay, which country or region is the biggest loser from the trade war? What do you say? US? Well, it's actually Europe. The EU. All the countries that you see colored blue on this map are countries that has the EU as its main trading partner. So for us, it's of course extra important that this doesn't spiral out of control. The Nordics are very, very much dependent on trade. I think that in Latvia, you have like 60% of your GDP made up from exports. So, this is a big potential problem for Europe if things continue to deteriorate. But Europe has other problems as well, right? There's always problems in Europe. And this is perhaps the most pressing one, Italy. Have you been following the situation in Italy? Political mess. They have a huge public debt. And they are now conducting a fiscal policy which is not to the liking of the EU Commission and Germany and other stable countries. And they are now being punished over this in the fixed income market. This is the spread that Italians are forced to pay over German when they want to borrow money 10 years out. We think that Italy is going to sort of comply to a reasonable extent with the EU demands, so it will not end up, as Juncker warned, to become a new Greece. That would, if that happened, of course, be the end of the whole Euro project, so we think that ultimately it will not come to that. Growth-wise, things are looking okay. These are the big 4 European economies, and they are all doing quite okay, especially Spain. Italy, they're still lagging. We do expect Italy to sort of pick up some steam, but it seems to be a very long process. So, 3 out of 4 are now above where they were before the financial crisis. So, what do you think about the Baltic countries? How have you been doing? Very well, correct. The Baltic countries have actually been doing quite well. Both Lithuania and Estonia are now actually, they've risen above Germany. And you had a very good stretch over last year and this year in Latvia as well. I'm not an expert on the Latvian economy, but basically we think that it's going to continue to develop in a very decent way. You had extremely strong growth here in the second quarter. Obviously, as we heard before, the construction sector seems to be a big driver. But there is, of course, also the problem with the labor market. The shortage of laborers for various reasons is driving wages quite high. And this is something that you, of course, need to watch for the future, so that you will not end up in a sort of disadvantage sort of cost comparison to other countries. But overall, things are looking quite decent, as we see it, for Latvia over the coming years. The labor market is tight in Latvia, but it's tight in many countries these days. If you look at unemployment levels in some big economic regions, you can see that all of them are now actually lower than they were before the financial crisis. So labor markets are extremely tight. And the normal thing that happens when you have tight labor markets is, of course, that wages tend to increase and you get some inflation. And if you look at inflation in Europe, you can see that, well, it's now actually a little bit above where the ECB wants it. But you should remember one thing. There is inflation and there is inflation. There is inflation that central banks like, and there is inflation that they don't really like. And the problem is that this inflation is inflation of the kind that the ECB really doesn't care much for. If you look at core inflation, where you try to strip away some of the more volatile components of price increases, it looks like this. It's basically flatlined. It's stuck around 1%, slightly lower than 1% currently. So what's the difference between the curve and the bars? Oil. I thought I heard oil. And that's absolutely correct. Or energy prices in a slightly wider context. You can see if you add energy prices, you explain why inflation was high here in 2012 and why it was pressed very low in 2015 and why it's now a bit higher again. But oil prices, energy prices is not a reliable source of inflation for a central bank. What they want is wage increases. Now, there is a gold star in the pot here for anyone who recognizes this man. He's a very famous person. Well, his name is Bill Phillips. He's famous for two things. The first thing was an invention that he made in 1949, which was actually something as weird as a hydraulic computer. So basically, it was a computer that was driven by liquids. And he used this machine called the Moniac to actually make a model of the British economy. So you had the treasury on top here, and then you had consumers and corporates, and then you had the pump here that sort of pumped this fluid back into the treasury, and that was sort of the taxation. And then you could get a printout of how the economy was doing here on this piece of paper. Do you remember this machine? No. He was famous for this machine many years ago, but he also made another invention, which he is still famous for, and that is the Phillips curve. Have you heard about that? The Phillips curve. Very, very important relationship that has been used widely by central banks and has influenced how they look at the economy for many, many decades. And what it basically says is that there is a relationship between the level of unemployment in the economy and how high the inflation rate is. So if you want to lower your inflation, well, then you basically have to accept that the unemployment level is quite high. But this hasn't really worked over recent years. So some people actually say, well, globalization and other things have actually killed the Phillips curve. So you can basically have unemployment as low as you want, but it will still not increase inflation because production will just move abroad. So where are central banks today? Well, they probably say that, well, the Phillips curve is not dead, but it's sort of weaker. The relationship is weaker than it used to be. And this is sort of formulating the basis for what central banks are doing today. And our forecasts for what central banks are going to do over the next few years, you can see in this table. And, well, we are seeing rate hikes, yes, but from extremely low level at very low paces. So in Europe, even in December of 2020, we don't expect interest rates to have been hiked above 1%. So even though we are seeing interest rate hikes in most economies as of now, it's not going to amount to very much. And this means that this problem, well, depends on how you look at it. Negative interest rates. This is how it looks today, or basically yesterday. All the red squares here represent negative interest rates. Latvia is not included here, but I looked it up, and your finance minister can go to the market and say, I want to borrow money for 3 years, and the market will tell your finance minister, okay, we will pay you 20 basis points for that privilege to lend you money. It's a fantastic thing. Do you know how long we've had negative interest rates? When did we see the first sign of negative interest rates? How many years ago? I guess? 5 years? Well, it's actually 6 years. That's close. When this happened the first time, everybody said, oh, this is so temporary. Pay attention now, because when you blink again, it's gone. Now it's 6 years. And it's not gone yet. The reason why we have strong growth and very low interest rates is because we have very low inflation. And there are some structural drivers that I think are important to explain why inflation has been so low. And that might also give us a clue to what will happen with inflation in the future. If I could have any pick of any economic indicator that I would know how it would develop for the next 10 years, it would be inflation. Because that's the key to interest rates, it's the key to stock markets, it's the key to real estate prices, basically everything. So what are the structural drivers of the low inflation environment that we have? Well, first of all, it's globalization. And that's nothing new. It's been going on for a long time. But the new thing is that it's sort of switching, it's changing phases. It's going from something that has most to do with goods production to now be something that also affects service production in a very, very strong capacity. And in a typical European economy, this is like 80% of the labor market. So globalization is still affecting inflation. If you want to go out and buy something today, which is slightly more expensive than a bag of groceries, what do? Internet, yeah. You go to one of these sites on internet where you can compare prices, and everybody's doing that now, and everybody can shop from anywhere in the world, more or less. And that creates an extreme downward pressure on prices. Then we have middlemen. That's a sort of dying breed, I would say, because we have all these new technology that is connecting the producer directly with the consumer, and all these sort of cost links that usually were in between are getting eaten away, little by little, sector by sector, also creating a possibility to keep prices quite low. And the last one, which I also think over time will become the most important one, is automation. Basically, that machines and computers are getting increasingly good at doing the tasks and jobs that were prior reserved for people. So, there's been a lot of academic research focused on this area. You've probably seen these studies that, well, in 20 years, half of the jobs will be gone. Are you afraid of robots? Is this something that you dream scary dreams about? Well, I think that it's perhaps not something that is such a huge problem over the long term. But the problem, as I see it, is the pace of change. Because if something happens gradually to an economy, then the economy has every means of adjusting. But if something happens rapidly, it becomes much more difficult. People get hurt in a much bigger way. So, AI is obviously a big thing, and it's something that I think that it will impact not just our children's future, but also our future. And you can illustrate AI, and you can talk about AI. I'm sure the speakers that come after me will do that as well. But just to try and illustrate the risk, the speed, I've used chess. Are there any chess players in the room? Don't worry, I won't ask you up and have a game of blitz here on stage, but a few. OK. Chess was invented about 700 years ago. At least modern chess, where the pieces move the way we are used to today, and the rules are basically what we have today. So, from that time, it took 750 years before we had grown as intelligent to actually be able to construct a machine that could play this game. And this machine was one of these big early computers. It was not very good. Probably even a moderate player, just as myself, could have beaten that machine. But things continued, and 25 years after that, we had this epic game. Anyone know? Who's the guy in despair here? Kasparov, exactly. The reigning world championship in 1997, I think it was. And he lost to IBM's supercomputer, Deep Blue. It was the size of a room, but it managed to beat the world champion. And from this day, machines have always been better than humans. You might think that the story ends here. But machines, they continue to play chess, and they play each other. So, over the next 20 years, up until last year, you had continuous tournaments where computers played computers, and the reigning champions of this game in 2017 was a software called Stockfish. OK. Then a well-known company named Google decided to have its AI, AlphaZero, have a go at chess. So, how long do you think it took for AlphaZero to beat Stockfish? 4 hours. 4 hours. From knowing nothing about chess, only the rules, to beating the best chess program in the world. So it's like if I would have come in the morning and knowing nothing about chess, and just before lunch, I would be the reigning world champion. So this is the biggest risk as I see it. It's the speed of things. If things evolve in a fairly gradual way, it's not a problem for society to actually adapt and cope with change in a very orderly fashion. But the quicker things are moving, the more problematic that becomes. OK, let's leave the AI and just go to the summary. And if you want to summarize my message to you today, is that it's going to be these 3 things. We're going to have decent global growth. Yes. As far as we can say, that is going to be the environment for the next year, probably even 2 years. Low inflation. It's not going anywhere. We're not going to see rapidly increasing inflation. And this means that interest rates, they will also remain quite low. They will rise a little from where they are today, but they will not rise a lot. And this should also be a fairly conducive environment for a lot of assets, like real estate, stock markets, and so on. When you talk about stock markets and that stock prices are going up, there is, of course, also always extra caution and need for us as a bank to have a disclaimer. You know, compliance office in SEB, they are very, very strict in forcing me that, Johan, you need to show them a disclaimer so that they don't believe everything you're saying. And I'm going to do that, to finish off with that. And it's not a disclaimer like you're used to. You can see that the text is much, much too large here, but nevertheless, it's a way of showing to you that forecasting is difficult. And this example is from a US company that was very early into computers, building computers. Already in the 1950s, they started doing this. And the management of that company, they had a profound vision, basically, that they told their most senior engineers and scientists that we want you to come up with a view of how a computer will look like 50 years into the future, i.e. in 2004. And they sat down and thought hard about this problem, and they came up with all these things which they expected to happen. And then they built this computer. Of course, it didn't work, but it was a physical representation of how they envisioned this computer to look like. And that is preserved in this picture. And now you can compare. Is this how a computer looked like in 2004? Well, quite far from it, right? Anyone have any idea what this wheel is for? To this day, I've not been able to find out. Thank you very much.